Hi everybody, welcome to another video of what's moving the markets. This, as always, is going to be a very interesting one. We've got inflation data that has come in recently. We're going to talk about that, and we're going to put it in context of last week's jobs data, and then we'll talk about how Fed is looking at this week's inflation data put together with last week's jobs data, and in this entire context, what are the key investment opportunities that we can focus on, right? So how CPI, jobs data, and Fed decisions are shaping market rotations, that what's going on in terms of the different sectors, which sectors are expected to benefit, which sectors are not expected to benefit. So let's get started. Now, first of all, this is just confirming what has been our expectation. And like I told you in earlier videos, that when the Federal Reserve cut the interest rate by 50 basis point, there was a camp which said, oh my god, it's really bad, it's all doom and gloom, because the last time they cut in such big ways, which was 2001 and 2007, we saw huge recessions after that and the markets crashed. This time is going to be just like that. And I said no. Because this time, even though they started with a 50 basis point cut, they're going to have a much slower easing. And the reason for that is because the economy is in pretty good shape. It's not like we're having a dot-com bubble burst like in 2001 or the global financial crisis of 2007. And you can see now that the data is supporting a slower easing. So the next cut is either going to be 25 basis point. So currently we are at 4.75% to 5%, right? So if we cut by 25 basis point, we will go to 4.5 to 4.75. And there is now some probability saying that they might not cut at all. They might stay higher for longer. And why is that? Because inflation was expected to be 2.3, but it came in at 2.4, which is still lower than the 2.5 of August. And that's good. It is slowing down. It is cooling down, but not as much as expected, right? So this is good. And you have to put it in context, right? So before this, we saw that huge data came out from the labor market, very, very strong labor market. And you have to try and understand what that means. The Federal Reserve has a dual mandate, which means they want to keep inflation low, lower than 2, and it's clearly not lower than 2 right now. At the same time, they want to keep unemployment low, and unemployment is very low. The labor market is very strong. So they are not going to reduce the interest rate until inflation comes to below 2, and as long as the labor market is strong, they can afford to keep the interest rates higher for longer, which is what you can see from the CME Fed Watch tool, that traders are pricing in an 89.5% probability of just a 25 basis point cut and a 10.5% probability of no cut at all. So the discussion of another 50 basis point cut, which was the scenario in 2001 and 2007, is completely out the window, right? There's no chance that we are going for a massive recession. The economy is good, the economy is strong, and you can even confirm this from the bond market, right? Treasury yields on the long-term bonds went up, which means the bond market is convinced that the rates are going to be higher for longer. Now, what does that mean? See, you have to understand that higher interest rates mean different things for different sectors. So we're going to look at the different sectors, which sectors are more sensitive to rate changes, which sectors are less sensitive, what does it mean for the short term, what does it mean for the long term. So let's get into the sector-wise performance and the discussion about what we can expect in the future. Now, first of all, don't be fooled by the strong performance of the tech sector. I have showed you these charts before. In the last week's video, I showed you that there is a divergence happening. What a divergence means is that the market is going up, but the RSI is coming down, right? Market is making higher highs while the RSI is making lower highs. So the peaks are for the RSI are getting lower, but the troughs for the market are getting higher. And this is classic textbook bearish divergence. And I'm specifically talking about the tech sector here, because even your S&P 500 is so heavily weighted by the tech sector. Even if you look at the chart for the Nasdaq, and I showed these to you last week, they both look the same, because S&P is pretty much weighted, so heavily weighted by the tech sector that is what it's really showing you, the behavior of the tech sector. And yes, they have been going up. This week also Nvidia went up, Microsoft went up, Salesforce went up, and there is still, of course, a lot of growth that is going to come in this. It's fundamentally very, very solid, but in the short term, very likely we're going to see a correction over here. So the whole point is, the quality of a good analysis is being able to tell before the prices start coming down, right? Because only then you will be able to take your exit. So the prices are still going up, but there is a divergence, which means you should be selling, not buying in this sector right now. It's at a very high multiple. You should be taking your exits and then re-entering once there is a little bit of a correction, right? Now, the question is, what's going up? Which are the sectors which are going to benefit from this higher rate, and what's really going on in those sectors? So first of all, obviously banks, they make money when the interest rate is high, and they have benefited from these high interest rates, and they will continue to benefit in this high interest rate environment. I mean, just look at JP Morgan, their results, fantastic results, and expected to continue to make money because the interest rate is going to stay higher for longer, which is a good thing, because in terms of the economic cycle, right? I mean, a little bit of a back to school in terms of what is the business cycle. So the economy kind of grows like this, right? I mean, it's in cycles. There's a boom and there is a trough, so there is a recession, but we don't want the recession to be very big. We want it to be as small as possible and turn around and start going back up. So what we are seeing right now is that the Fed seems to have done a very good job, and they have, instead of going for a very big recession, probably been able to turn the economy around, and the recession has already passed, right? And we're going to start going back up. So this is what you call a soft landing, right? I mean, if the GDP had reduced a lot more, and it was expected to reduce a lot more, where unemployment would be going out of control, which it is not, right? Then we would have said, oh, we're going to go for a massive recession, corporate earnings are going to take a big hit, GDP of the entire world and country is going to go down a lot, but that doesn't seem to be happening. It seems like the Fed has got a soft landing, which means the recession is almost over, and now we're going back into the positive growth cycle, which is good for the industrial sector, right? And it's a little mixed over here, because there is definitely a lot of defense spending because of the military conflicts that are going on. So under the hood, within the industrial sector, it's not all infrastructure projects in terms of industrial machinery. There is a lot of government spending which is not related to normal industry. It is related specifically to defense industry. But overall, yes, these sectors are benefiting, which again ties in with demand for copper and demand for steel, and we're going to talk about that again, which also needs to be discussed with the perspective of the technology sector giving their cash to the utilities sector, because they need electricity for the data centers, and the data centers are getting the electricity from utility companies, which have been using coal and natural gas to make that electricity, which is obviously now creeping up with them in terms of higher input costs, and they have to transition to renewable energy, which will be, number one, cheaper, and number two, better for the environment, and they're not doing it fast enough, which means they're just going to pull up their socks and catch up on that, which again brings us back to copper and lithium, that we are going to see demand for these commodities, stable demand, which means stable prices, which means good for the commodity producers. So it's just confirming what we have been expecting all this time. One more thing which will confirm all of this, right? So the relative rotation graph shows us that the NYA is getting strong, whereas the XAX is getting weak. Now let me explain a little bit what is NYA and what is XAX. NYA is mostly large cap companies, right? And XAX is more small cap and mid cap as well. So we can see clearly that the NYA is doing better and the XAX is not doing that well, because if you look at data of loans, that how many companies have loans, you will see that your smaller companies, your small to mid cap companies have a lot more debt as a percentage of their balance sheet compared to your large cap companies. So a higher for longer interest rate environment, right? So we obviously have a slower easing, which means interest rates will remain high. And why is that bad for small companies and mid cap companies, but mostly small companies? Because they have a lot of debt on their balance sheet. And all of that debt, or majority of that debt, is on a floating interest rate, which means they don't have a fixed rate debt. Let me give you an example. Amazon, when the interest rates were low, issued a bond at a fixed rate. So they got funding at a fixed rate, which was a very, very low rate, right? It was the lowest corporate issue in terms of rates of that time. And then the interest rates went up. But the smaller companies, they don't have the luxury to do that. So they borrow on floating rates, which means when the interest rates go up, their cost of borrowing goes up. And now it is up and it's staying up. So their cost of borrowing is going to stay high. Number one. Number two, if you look at majority of the small cap companies right now, they are in losses. The large cap companies are in profits, and they have relatively smaller debt as a percentage of their balance sheet, and some of them are fixed rates at low rates, so they are really enjoying this. And if you're a bank, right, you're a large cap bank, you're definitely enjoying this because you're earning based on that high rate. So what we are seeing over here is that large caps are doing better, but not all large caps. You have to see which sectors. So financials are doing really well, which is banks, because of the higher for longer interest rate environment, and industrials are doing really well. And that, yes, there is an element of defense spending over here, but there is also proper industrial machinery being manufactured, which is also doing well, which again ties in with our demand for copper, and we'll talk about that. Another thing, I want to tell you over here is that it's not the technology stocks which are continuing to do well, even though you see that they are going up. But when I say divergence, the rate of growth is slowing down, right? I mean, you can see that they are breaking their momentum and they are going to roll over, which you can see by this rotation of the NASDAQ, right, which is obviously your tech stocks. First it was in the leading quadrant, then it went into the weakening, and now it's in the lagging. So clearly, if you just zoom out and look at the bigger picture, you can see that it's not your tech stocks which are outperforming. They are breaking their momentum. They are still going up, but at a lower rate, and obviously they're expected to roll down. So now, what does all of this mean? Yes, the long-term fundamentals are very solid for technology, but I have told you many times, we've discussed this many times before, that cash is flowing to utilities through the data centers, right? And utilities are now finally seeing the high costs of their fossil fuel-based energy generation, and they have to go for renewable energy, which will drive up the demand for the copper and lithium and stainless steel oriented commodities. And now industrials are going to add to that, right? So the whole thing is industrial machinery and renewable energy will continue to drive demand for materials, right? And if you take exposure in the commodity producers, right? The producers of key material. I'm not talking about speculating on the price. I'm talking about taking an exposure into companies like Rio Tinto and Freeport McMoran. But again, not investment advice. This is just to give you an idea of what I think, that if you have stable demand for copper and lithium and stainless steel and iron ore what you will see is that companies which are producing these key materials will continue to have stable prices, stable revenues, which is good to be exposed to, where as the tech sector sort of takes a correction, and then you can rotate back into the tech sector once it's a good opportunity to enter back, right? So this seems to be a sound long term strategy for the time being, driven by AI, because AI cash is flowing to data centers and then through utilities, and obviously they need to upgrade using green energy, and also because of defense spending and otherwise industry going up, because as the Fed seems to have done a soft landing and we're heading back up in terms of growth, so obviously industrial machinery and key materials like copper, because we call copper Dr. Copper. Why we call copper Dr. Copper is because it's a very good indication of how the economy is doing. So if copper starts going up, that means the economy is now starting to recover, and we've already passed the recession, and we've had our soft landing. And if inflation is now cooling down, right, and inflation is a lagging indicator, so that means we are now hopefully going back up, which is good for copper and linked materials and sectors, right? So this is again just confirming what we have been saying, which is good. So let's keep on this and wait for the tech correction to rotate back into tech, right? So as always, if you found this useful, please like, share, and subscribe, and leave your comments. And hoping to see you next week.